Today we're tackling a really fascinating question, one that gets right to the heart of value investing.
Mm-hmm.
Can Aflac's, decades-old cash machine in Japan keep fueling those shareholder returns? Or is this insurance giant maybe facing some inevitable erosion?
Yeah, is the fortress starting to crumble? That's the big question.
Welcome, everyone, to the Deep Dive. We're digging into Aflac Incorporated today. That's ticker symbol AFL on the New York Stock Exchange.
And just for context, all our analysis, everything we talk about, it's anchored to June 21st, 2025.
Right, and on that date, Aflac closed at $102.63 per share.
So our mission here is pretty clear. We want to really dissect Aflac, look at the business, the management, the financials, its competition.
All through that rigorous value investing lens.
Exactly. Trying to answer that fundamental question, is this a good long-term debt for generating returns for you?
Okay, so we've structured this deep dive into two main parts. Makes it easier to follow.
Good idea.
First up, we'll tackle chapters 1 through 3. That's the core stuff. Understanding the business, evaluating management, and a really thorough financial analysis.
The foundations.
Exactly. Then, in the second half, we'll shift gears. Chapters 4 through 7, market sentiment, who owns the stock, risk assessment, and then we'll, tie it all together in the conclusion.
And we'll make sure to clearly signpost those chapters as we go.
Definitely. Get ready for those distinct chapter announcements. All right, let's kick things off then. Chapter 1, business analysis.
Okay.
So Aflac, they operate this classic dual-engine insurance model. You got Aflac Japan and Aflac US.
Right, and it's a model value investors often because it generates float.
Explain float for us quickly.
Sure. Float is basically the money Aflac holds onto. They collect premiums from you, the policyholders, but they don't pay out claims immediately, so they have this pool of capital.
Like an interest-free loan.
Exactly, which they can then invest. So the revenue really comes from two places. Net earned premiums, that's the steady cash coming in from policies.
Predictable.
Very. And adjusted net investment income, that's the money they make from investing all that float. For fiscal year 2024, their total revenues were around, $18.9 billion?
Yeah, about that. And their specialty is really supplemental insurance.
Mm-hmm. Not your main health coverage.
No, this is different. Their policies pay cash benefits directly to you, the policyholder. It covers those out-of-pocket expenses.
Right. So it's about financial protection, peace of mind, lets you focus on getting better, not stressing about bills hitting the mailbox.
That's the value proposition.
Now, looking at the two engines, Aflac Japan is the powerhouse. It's the largest, most profitable segment.
Way bigger than the U.S. side.
Oh, yeah. They lead in what Japan calls third sector products, cancer, medical, life insurance. They actually pioneered cancer coverage over there.
Really? Didn't know that.
Yeah, decades ago. And they keep innovating, like with Sumitasu in 2024, which is a retirement-focused life product.
And the market share stat is just incredible.
It's stunning. Aflac insures 1 in every 4 households in Japan. 1 in 4. That accounted for 55% of their adjusted revenues in 2024. Just massive dominance.
That kind of penetration, that suggests a really deep moat in Japan.
Absolutely. Decades of building trust, building that distribution network. It's hard to replicate.
Okay, what about Aflac US?
The U.S. side focuses more on worksite voluntary benefits. Stuff like accident insurance, short-term disability, critical illness, hospital plans, dental, vision.
Things offered through your employer, usually.
Typically, yeah. And they've been enhancing things there, too, like a new holistic accident policy recently. Still focused on that core idea.
Yeah.
Quick cash benefits when you need them.
Okay, zooming out to the industry level, what trends are shaping things?
Well, digital transformation is huge everywhere, right? AI, data analytics for, hyper-personalization of policies and service.
Makes sense.
There's also more demand for flexible care, virtual health, in-home care options. And a big tailwind, especially for Aflac US, is the growth in the voluntary benefits market itself.
You mentioned a projection.
Yeah, it's projected to grow, I think, around 7.1% compounded annually between 2022 and 2027. So solid growth potential there.
But they're not alone in this space. Who are the main competitors?
Key players you'd look at are folks like MetLife, M&T, Prudential Financial, PRU, Unum Group, UNM, big names.
How does Aflac stack up?
It's interesting. Aflac consistently has much better net profit margins. We're talking like 21% versus maybe 6% for MetLife. Really efficient.
But
it trades at a higher PE ratio, around 16 compared to MetLife's 13-ish. So the market sees that quality, that efficiency, and is willing to pay a bit of a premium for it.
What about the regulatory side? That's always crucial for insurers.
Definitely. In the U.S., it's mostly state-by-state regulation, complex patchwork.
And Japan?
Japan is different. It's centralized under the Financial Services Agency, the FSA, governed by the Insurance Business Act of '95.
Okay.
And the really big thing on the horizon there is this new framework called Economic Value-Based Solvency, or ESR, coming in 2025-2026.
ESR. What's the impact?
Well, it aligns Japan more with global standards, like Solvency II in Europe. It could really affect how Aflac invests its float, how it uses reinsurance, and crucially, how much capital it has left over for things like buybacks and dividends. Something to watch closely.
Seems like a tough industry to just jump into. High barriers to entry.
Oh, absolutely. Formidable barriers.
Yeah.
First, you need huge amounts of capital, like $1 billion minimum just to start in Japan.
Wow.
Then there's the complex licensing. Getting FSA approval can take, well over a year, including prep time.
And then there's the brand.
Exactly. Building brand trust, building distribution networks like Aflac has, that takes decades. You can't just replicate the Aflac duck overnight.
That duck is a perfect transition to competitive advantages. Brand strength has to be number one, right?
Absolutely iconic. Took U.S. brand recognition from under 10% to over 90%. It's a marketing masterclass.
Plus 24 years on Fortune's World's Most Admired Companies list. That's consistency.
It really is. And don't forget, economies of scale, with over 50 million policyholders worldwide.
Especially leveraging that huge base in Japan.
Right. They can spread their fixed costs over a massive revenue base. Huge cost advantage.
And what about keeping customers? Switching costs.
Yeah, insurance often feels like a set it and forget it kind of thing for people.
True.
You don't really want the hassle of shopping around. You worry about losing good terms you might have. And if it's tied into your workplace benefits, it's just easier to stick with it. Those are real switching costs.
And finally, those unique assets. We mentioned the distribution network in Japan.
Unparalleled. Reaching 1 in 4 households. And that strategic relationship with Japan Post Holdings.
Who's also their biggest shareholder.
Exactly. It's a key distribution partner and the largest owner. That deepens the moat significantly. Makes Aflac incredibly entrenched, very hard to challenge directly in Japan.
Okay, that gives us a solid picture of the business. Let's pivot now to the people running the show. Chapter 2, Management Evaluation.
Leadership is critical.
And Aflac has incredible stability at the top. Daniel P. Amos, CEO since 1990.
Yeah, his tenure is second only to Warren Buffett among current Fortune 500 CEOs. That's remarkable longevity.
And the track record. Revenues grew from about $2.7 billion to nearly $20 billion under his leadership. He was behind the Aflac Duck campaign, too, consistently ranked as a top CEO.
That long tenure provides stability, but you also want to see how management handles challenges.
Like the recent cybersecurity incident, June 2025.
Exactly. That was a real-time test. Unauthorized access via social engineering. They stopped it within hours. Apparently no ransomware involved.
But sensitive data might have been compromised. Health info, social security numbers.
Right. So how they handled the fallout, the communication, the remediation, that's a key indicator of stewardship for you, the stakeholder, right now.
On the topic of transparency and ethics, though, Aflac has a strong record.
They do. They pioneered the say-on-pay vote, giving shareholders a voice on exec comp.
And 19 years straight as one of the world's most ethical companies, since 2007.
That consistency suggests a deeply ingrained ethical culture, which is definitely a positive.
Okay, let's talk capital allocation. How does management deploy the cash Aflac generates?
Well, they consistently invest back into the core business. We see ongoing investments in digital tools, new products like Sumitasu in Japan, those enhanced accident policies in the U.S.
And acquisitions?
Their M&A seems pretty disciplined, focused on boosting existing strengths, like that deal in May 2024 to buy a 40% stake in Treeline Capital Partners.
Why Treeline?
They're in private credit. So the idea is to enhance Aflac's investment income by getting exposure to that asset class. Smart, bolt-on type acquisition.
But for many investors, Aflac is really about returning capital directly, right? Dividends and buybacks.
Oh, absolutely. It's a core part of the investment thesis. Aflac is an S&P 500 dividend aristocrat. Meaning they've increased their dividend for at least 25 consecutive years. In Aflac's case, it's an incredible 42 consecutive years.
42 years.
Yeah. And they're aggressive with share buybacks, too. Spent about $2.8 billion on repurchases in 2024 alone. That creates a nice buyback yield of 4 or 5% annually.
What's the current dividend?
The latest quarterly was $58 per share. So annualized, that's $2.32, giving you a yield of around 2.26% at the current price. And it's very well covered. The payout ratio is conservative, only 36% of earnings. Plenty of room there.
How does this all translate into returns on their investments? ROIC.
Return on invested capital, yeah. This is where Aflac really shines, showing management's effectiveness. The ROIC has been strong and actually improving.
Numbers.
Went from 9.5% back in 2020 up to 16.9% in 2024. The average over that period is nearly 13%.
And why is that good?
Because it significantly exceeds their estimated cost of capital, their WACC, which is around 9.5%. When ROIC is higher than WACC, it means management is creating real economic value for shareholders with the capital they deploy. It's a very positive sign.
Okay, management looks solid. Now here's where it gets really interesting as we dive deep into the numbers. Chapter 3, financial analysis.
Let's crunch some numbers.
First off, market cap. Around $55.2 billion. So definitely a large cap stock.
Solidly large cap.
But the big one, revenue growth trends over the last 5 years.
Yeah, this is the central concern, isn't it? We've seen a negative compound annual growth rate somewhere between -3% and -5%. Revenues have actually shrunk.
From over $22 billion in 2020 down to under $19 billion in 2024.
Right. It's contracting.
Now, we touched on why. Structural runoff in Japan, those older policies paying up.
Currency headwinds from the weaker yen haven't helped either.
But the U.S. side is growing, albeit modestly.
Correct. So the whole bull versus bear debate really hinges here. Can the U.S. eventually outgrow the Japan decline? Will the yen strengthen? Or will the top line just keep slowly eroding? That's the tension.
Despite that top-line pressure, profitability is remarkably strong.
Exceptionally strong and stable. Operating margins consistently around 27%. Net profit margins around 21%.
And that's held up over time.
Pretty much. Shows they have pricing power and manage costs well, even with lower revenues.
Okay, but here's another metric that raises an eyebrow. Free cash flow.
Right. Unlike the stable profit margins, net cash from operating activities, a good proxy for free cash flow here, has been trending clearly downwards.
How much?
It fell steadily from almost $6 billion in 2020 down to about $2.7 billion in 2024.
That's a significant drop. What are the implications?
It's a major bearish consideration. It really makes you question the long-term sustainability of those massive share buybacks and dividend increases if the actual cash generated by the business keeps declining like that.
Yet, if you look at earnings per share, diluted EPS has been consistent and growing.
True. Profitable every single year for the last 5. EPS rose from around $2.93 back in 2015 to $9.63 in 2024. Looks great on the surface.
But there's a but.
There's a but. A lot of that EPS growth has been driven by those aggressive share repurchases. They're buying back shares, reducing the share count.
So each remaining share gets a bigger slice of the profit pie, even if the pie itself isn't growing much or is even shrinking slightly in cash flow terms.
Exactly. It's financial engineering. Effective for boosting EPS, but you need to understand how it's being achieved.
What about financial stability? Debt levels?
Balance sheet looks quite conservative. Debt-to-equity ratio was about 0.29 as of Q1 2025, well within historical norms. Prudent leverage.
And liquidity. Standard ratios like the current ratio?
Those aren't as useful for insurers given their long-term assets and liabilities match up. But looking holistically, Aflac's liquidity seems robust. No immediate concerns there.
And we already covered the dividend stability, 42 years of growth, impressive 5-year growth rate around 13.7%, safe payout ratio near 31%.
Rock solid on the dividend front historically.
Okay, let's talk valuation. How does the current price stack up? PE ratio.
The trailing 12-month PE is currently around 16.0.
How does that compare?
Well, it's significantly higher than Aflac's own 10-year historical average PE, which is closer to 10, so a 60% premium to its own history.
Wow. And compared to peers?
Also looks a bit rich. MetLife is around 13.4, Prudential 14.2, Unum is way down at 8.5.
So why the premium?
The market seems to be valuing its perceived quality, that consistent profitability, and especially the shareholder yield from buybacks and dividends, despite the negative revenue growth.
What about intrinsic value? We use a DCF model for that.
Right, discounted cash flow. We project future free cash flows, discount them back to today's value to estimate what the business might be worth on a standalone basis.
And our educational model suggests.
Our model estimates a base case intrinsic value around $105.14 per share. The overall range is probably somewhere between, say, $90 and $105 per share.
What are the key assumptions driving that estimate?
We use a discount rate of about 7.4%, a terminal growth rate long-term of around 1–2%. We forecast a modest revenue recovery over the next 5 years, maybe a 2.7% per CAGR, and we assumed those strong net margins stay stable, around 21–22%.
All right, let's shift gears into the second half. Moving on, let's explore market perceptions and technical indicators with Chapter 4, Market Sentiment.
How's the street feeling about Aflac?
Pretty neutral, actually. The consensus analyst rating is basically a hold. Zacks gives it an average broker rating of 3.06, right in the middle.
And price targets.
The average 12-month target is somewhere between 105 or 188.
Yeah.
Very close to where the stock is trading now.
So analysts aren't expecting big moves either way.
Doesn't seem like it. The full range of targets is pretty wide, from the low 80, 90 doors up to maybe $125 or so, but the average is right near the current price.
And recent news, that cybersecurity incident must have impacted sentiment.
For sure. June 20th, 2025, the media coverage was factual, cautious. It definitely introduced some uncertainty that wasn't there before. What about market indicators? Short interest.
Very low. Less than 2% of the float is shorted, about 9.6 million shares. Meaning there isn't a big institutional bet against Aflac right now. People aren't piling in expecting the price to fall hard. Reinforces that neutral view.
But technically, moving averages.
Yeah. The price, $102.63, is currently trading below its 50-day simple moving average, which is around 104, 107.5.
Bearish signal.
Technically, yes, short-term bearish, and it's also below its 200-day moving average, which is around 104, $107.
So longer-term bearish signal too.
Correct. Both suggest negative price momentum right now, technically speaking.
Okay, let's unpack who actually owns Aflac in Chapter 5. Ownership structure.
Who holds the shares?
Mostly large institutions. About 67% to 69% of shares are held by institutional investors. Pretty typical for a large-cap company.
Big names like Vanguard, BlackRock.
Yep. Vanguard's the top holder with about 9.5%. BlackRock has nearly 8%.
But the really crucial one here is Japan Post Holdings.
Right. The single largest shareholder with 9.6%. More than Vanguard.
And it's not just an investment. We talked about this. They're a critical business partner, a key part of Aflac's distribution network in Japan.
Solidifies the moat.
Yeah.
Makes a hostile takeover pretty much impossible.
Exactly. Very strategic holding.
Now, what about insiders? Management, directors?
Insider ownership is quite low, less than 1%. That's not necessarily unusual for a company this size.
Okay. But what about their recent trading activity? Buying or selling?
This is where it gets interesting and maybe a bit concerning for value investors. There's been a consistent pattern of insider selling over the past 3 to 12 months.
Selling. Any buying.
Notably, a lack of any significant open market purchases by insiders.
What does that signal?
Well, it's often seen as a considerable red flag. When the company is actively buying back its own stock, but the insiders, the people who know the business best, are consistently selling their own shares and not buying.
It suggests they don't see compelling value at the current price levels.
Precisely. It's a disconnect worth noting.
And overall ownership concentration.
Despite the big institutions and Japan Post, the base is relatively diffuse. The top 25 holders own less than half the shares.
Meaning strategic power really lies with the board and management.
Yes, which makes evaluating their decisions like capital allocation and handling risks even more important for you as an investor.
Here's where it gets really interesting as we delve into Chapter 6. Risk assessment using a SWOT analysis.
Strengths, weaknesses, opportunities, threats. Let's break it down.
Strengths, we've covered these. Iconic brand, the duck. Unrivaled market leadership in Japan, that 1 in 4 stat. Exceptional financial strength, strong margins, ROIC, extensive distribution network.
Powerful foundation, weaknesses. High dependence on just 2 mature markets, U.S. and especially Japan, which is still over half the revenue.
Concentrate.
Yeah. And product concentration mainly in supplemental insurance. Plus, sensitivity for financial markets, interest rates, investment returns.
Opportunities. What to go right?
Digital transformation and AI offer big potential, maybe 20–30% cost reduction possibilities down the line. Growth in that U.S. voluntary benefits market is an opportunity. Expanding through more strategic partnerships and continued product innovation.
And the flip side, Threats.
Intense competition is always there. Cybersecurity risks, that recent incident really underscores this one. Big threat.
Definitely feels more real now.
Evolving regulations, especially Japan's ESR framework we discussed, and just general macroeconomic headwinds, inflation, recessions, etc.
Let's dig into those macro factors. Inflation.
Persistent high inflation is bad news for insurers. It drives up the cost of claims, squeezing underwriting margins.
Okay. Interest rates.
Interest rates are that classic double-edged sword for insurers like Aflac.
How so?
Rising rates are good because future investment income on their float will be higher. But rising rates decrease the market value of their existing bond portfolio, which is usually large.
And falling rates.
Falling rates do the opposite. Boosts the value of existing bonds, but means future investment income will be lower. So they're sensitive either way.
What about specific geopolitical factors? Like those U.S.-imposed tariffs from 2025 mentioned in the analysis. How does that affect an insurer?
It's indirect, but potentially significant. Tariffs on imported goods raise the cost of, well, everything eventually. Cars, building materials, medical supplies.
Which pushes up claims costs across the board.
Exactly. Even if Aflac isn't directly insuring property, higher costs for things like car repairs or medical equipment eventually filter through the system and can raise them claims costs too.
And this leads to that margin squeeze idea.
Right. That's the forward-looking threat. You have rising costs from inflation, from tariffs hitting potentially limited ability to raise premiums quickly because the market is competitive and heavily regulated. That could squeeze those historically strong profit margins, a key risk to monitor.
Okay, we've covered a lot of ground. So what does this all mean? Let's bring it together in our final chapter, Chapter 7, Conclusion.
Synthesis time. The bull case versus the bear case.
Yeah, the analysis really shows a company with fascinating dualities, doesn't it?
It absolutely does.
So the bull case for Aflac. What are the pillars for, say, a conservative value investor?
Well, first, that durable economic moat. The Aflac Duck brand, the dominance in Japan, hard to challenge. Second, exemplary management focused on shareholders. Long-tenured CEO, that incredible 42-year dividend growth streak, massive buybacks.
Third,
Financial fortitude, conservative balance sheet, strong profitability even with revenue issues, high ROIC showing value creation. And fourth, the valuation, while not dirt cheap, seems to be within a reasonable estimate of intrinsic value according to our DCF.
okay, clear bull points. Now, the bear case. What are the critical challenges you need to consider?
Number one has to be the stagnant and declining top line. Revenue, free cash flow trending down. EPS growth is happening, but it's largely that financial engineering via buybacks.
Not organic growth.
Not really. Second, concentration risk, heavy reliance on Japan, sensitivity to the yen, and broader macro risks. Third, that insider selling pattern. It's a telling red flag.
Doesn't inspire confidence when insiders are heading for the exits.
No. Fourth, the looming threat of margin pressure from inflation and tariffs. And finally, the valuation looks rich compared to its own history and its peers right now. The market is already pricing in a lot of the quality.
And to recap the valuation summary, our educational DCF model put the intrinsic value range roughly between $90 and $105 per share.
Correct.
So the concluding outlook, Aflac's current share price, around $102.63, sits right within that range, maybe towards the upper end.
Suggest the market has it priced about fairly, perhaps?
Yeah. It looks like a high-quality, very mature, exceptionally stable business. Its main appeal for investors today seems to be that reliable shareholder yield, the combination of dividends and buybacks.
That's the core proposition right now.
So the primary risk, really, is if those bearish factors accelerate, especially if they can't stabilize those declining cash flows, because that would directly threaten the sustainability of the capital returns that investors are counting on.
Absolutely. That's the key thing to watch.
That was quite the deep dive into Aflac, really revealing a company of fascinating dualities, wouldn't you agree?
Absolutely. A prime example of why you need to look beyond the headlines. Understand the nuances. It's crucial for making informed decisions.
And for those of you listening who want to keep exploring companies like Aflac with us, please remember to like and subscribe to the Stock Analytics AI YouTube channel. It really helps us out. And for our dedicated members, it's just $4.99 a month. You get priority deep dives on tickers you request. Plus, over the next few months, we're actually covering all of the S&P 500 stocks exclusively for members.
Great value there. And of course, we always have to include our disclaimer.
Yes. Please remember, this analysis was generated by an AI system for educational purposes only. It should not be considered financial advice.
Always conduct your own thorough research or consult with a qualified financial advisor before making any investment decisions.
Okay, so given everything we've uncovered about Aflac, its strengths, its challenges, that commitment to returning capital, here's a final thought for you to mull over. Which one of these aspects, the brand, Japan's dominance, the dividend, the risks, if it were to change significantly, which one do you think would have the most profound impact on Aflac's long-term future? Something to think about.